Good afternoon, everyone. Thank you for taking a little time to sit down with me and the team that I have together here. My name's Aaron Ploskow with AAMA, and today we're going to go over the TAM market commentary for the first quarter. Basically, what we're going to do here is I have our CEOs from the three different firms that represent the TAM portfolios. We've got Kim Arthur from Main Management. We have Bob Baker from AAMA, and we have Felipe Toews from Toews. And basically, we're just going to go over a little bit about what each of them had to say about the quarter that we just came out of, and maybe hit them with a couple of questions on things that are happening right now. So, I'm going to direct here and just go through each member. And if you guys end up talking back and forth to each other, that's absolutely okay as well. But just let's just start off with what do you think some of the most recent developments in the first quarter that you see that are impacting the market today? Phil, why don't we go in order of TAM? So let's start with you at Toews.
Excellent. Okay. Yeah. So the beginning of the year, we were all salivating over the possibility that the Fed could cut rates 6 times. At the time, we felt like it was this perpetual state of over-optimism about how many Fed rate cuts were going to be coming along. It turned out to be right. Now we're down to like 1 or 2, maybe even less based on the data we just had come out today. So, but despite that, it was an environment that was favorable for bonds. And our space in the TAM portfolios is the tactical bond allocation. And so we were looking at historically what could or had happened in the past when the Fed was lowering rates for bonds. On average, since 1984, when the Fed lowered rates by meaningfully, ag bonds were up 26, high yield bonds were up 26. So it's a favorable environment for those portfolios. We were also reasonably optimistic about growth, and we can talk. I'll hit a little bit more on that later, and because it's an incumbent election year. So things have deteriorated from the beginning of the year in terms of expectations, but that was our feeling then at the beginning of the year and where we are now. Yeah.
Okay, perfect. Bob, how about you and AAMA?
Be happy to talk a little bit about the first quarter. Obviously, the first quarter was a good quarter for us. The equity positions accelerated well. If you were not heavily weighted in the top 10 of the S&P 500 or the Magnificent Seven, you lagged the S&P a little bit, but that's okay because now we're seeing the downdraft effect of those 7 to 10 stocks within the indexes. And from we're a sector valuation firm, and we really spent a lot of time on the fundamentals of the market. And with the acceleration in prices in the first quarter, it really pushed PEs to the higher level, and that always concerns us when they get so pricey. Not that we're predicting any kind of a pullback, but there's something out there that's going to make a change within the marketplace.
Absolutely. We talk about that quite a bit in a lot of our meetings. Kim, how about you? How did you guys see first quarter?
Yeah, first of all, I want to say, Aaron, thank you very much. I want to thank my fellow partners here, Phil and Bob. Awesome, having this great strategy that we're teamed up, and obviously thank all the advisors and clients. So one follow on to what Bob just said, 2023 was the year of the Mag 7. This year so far has been the year of the Mag 1, NVIDIA. So it is interesting how, the good news is there's been a broadening out in the market because the equity markets are up despite just having a Mag 1. So I think that is interesting. The first quarter, a lot of the same themes that both Bob and Phil said, but we focus a lot on what drives the market, and that is earnings. And earnings continue to plow ahead in the right direction in the first quarter, which is why you saw equities with a positive return on them. Why are earnings continuing to move higher? To really distill it down, there's all kinds of complexities around it, but it's because real wages have been positive now for 12 months. That was not the case in 2021, 2022. There was loss of purchasing power, but it flipped in about May or April of last year. And that is what is driving those earnings. And that's why people that have been calling for, recession starting back in 22, were wrong in 22, wrong again in 23, and so far have been wrong in 24. So we focus very much on that. And like Phil said, the big delta that happened is people thinking 5-6 rate cuts. Now we're down to 1 rate cut. The 2-year is actually predicting over the next 12 months that there's only 1 rate cut. Basically, you get 1 in December and nothing happening after. Like the market is prone to do, it gets psychotic in both directions. It's probably overstepped its bounds thinking that there's only 1 rate cut over the next 12 months. Something will come out to make a change on that. But that's what makes the market interesting. So again, looking at earnings better than expected, cognizant of that reset in the rate environment, and then clearly, trying to find the broadening out. That's definitely helped out a lot of managers like ourselves and probably Bob too. So.
Great. You bring up a lot of good points and a lot of things that I wasn't sure I was going to ask you guys to expand on, but you opened it right up with the end of your comments there. Yes, and Felipe mentioned it too. And I apologize to Felipe. I apologize to everyone else. I'm going to switch back and forth from Felipe and Phil probably 10 or 15 times in here. I've known him over at Toews for pushing 10, 15 years now, and I try to stay up on it as best I can. But what you both have mentioned is that over the past, let's call it 9 months, we've gone from 7 possible rate cuts to 6 possible rate cuts to 3 possible rate cuts to, I just heard 1 possible rate cut. And I actually believe, I brought it up at our meeting earlier this week. I read an article that UBS is actually starting to look for more hikes again. Now, with all of that in mind, and with the GDP number coming in and disappointing today, does that change anything that you think any of our clients need to think about, need to consider? Is there really a possibility that we're going to see rate hikes again? If we see that, is that going to hurt the bond side? If we start seeing things head back over that 5% mark, up to 5.25%, even on the two-year, how's that going to affect the way things go going forward?
You're going to come back to me first, Aaron?
Sure.
And as to the whole Felipe Phil question, it's like, who do you want to have a drink with? Felipe. Anyway, so
okay, I got that.
So I'm going to just hit on a couple of macro things, and then I'm going to focus on the bond story because we have 2 equity experts here on the call. The couple of things we look at, the first, and I think maybe the most poignant, is the history of incumbent election years, right? So if you go back to 1944, when a president is in office and is running again, the average return since 1944 has been 16% annual. There's never been a losing year in an incumbent election year for a president. And that's 13% higher than when a president is running not as, but there's no incumbent that's running. So that's a really important thing to think about. We have about $100 billion of additional fiscal stimulus from the CHIPS Act, from the Inflation Reduction Act, from student loan savings. And so all of that is potentially juicing the economy and is going to be helping stocks along. So that's number one. And number two is this issue around race that you mentioned. So if we're thinking about rate increases right now is like looking into the sun. It's just, you don't want to do it, but it's something you do need to contemplate. What's been really interesting to watch, though, is as we've seen this degradation from 7 cuts down to 1 or 2, these stocks have been advancing, right? So I think the key is that if we can get, if rates move higher, I think it's going to be limited. There's a limited number of times that the Fed would either not, reduce rates or increase rates. If stocks can find their way despite changes in perceptions about what the Fed's going to do, I think that could be a powerful sign. Now, finally, I'm going to talk about bonds, which I said I would do at the beginning of this part, which is that bonds are, in our opinion, in our view, attractive primarily because we're starting from a higher rate point. So our strategy can be in high yield bonds, investment grade bonds, 5 to 7 year duration, or T-bills. So looking at scenario analysis, if the economy is doing well and rates and inflation stay low, high yield bonds is probably going to be the place you want to be. The yield right now is 7.5%. That looks decent. If things go south, if the Fed does increase rates, if stocks do move down, if we do have a depletion of risk assets, then the Fed's going to become more dovish. Then investment grade bonds potentially can rally while the Fed lowers rates. So that's a good place to be. And finally, it used to be that when we were on the sidelines, we'd earn nothing. Now we are earning in the range of 5.25%. So frankly, bonds as a whole, and especially if you're adaptive in that space, are, in our view, reasonably attractive relative to where they've been now for 12 years. So, based on that part of the portfolio, you shouldn't worry because it's going to be adaptive. And I think any of those 3 scenarios I was talking about could still produce decent gains for bonds. The one thing I didn't mention is that Bob was talking about where you guys were positioned. We were just long high yield bonds the entire first quarter. In the last couple of weeks, we have moved defensive into a T-bill position, however.
Perfect. Bob?
Super. When we look at the market, we really focus on earnings, and there's forecasted earnings and actual earnings, and those 2 numbers can come in pretty dramatically different. But right now, we're in one of the 9 periods of time in which we've had overvaluations in the market in the last 50 years. But today is the first time since the financial crisis that we've had interest rates at levels, as Phil indicated, you're getting 5.5% on T-bills or cash, and that's pretty attractive. So, a couple of weeks ago, we actually, in the portfolios where we increase and decrease our equity exposure, decreased our equity exposure and increased our bond exposure. So, we kept it in the short-term environment, but not that we're forecasting the market's going to go down. But right now, we think there's a period of time in which, more conservative investors ought to be a little more heavily invested in short-term fixed income.
Good. Kim, how about you?
Yeah, a couple things I would just add on to that. One, I love Phil's comment about incumbent, the situation with the market there. Another kind of derivative off that is if you look when you're in a bull market in the 4th year of a presidential cycle, the market is actually ends up being up about 15%. So it's a little like the numbers that Phil said for just the incumbent running. But if you look at the granularity of that, the first quarter is up very nicely, just like we had. And then April, May is your corrective period, which kind of like what we have going on. We obviously had sentiment that got very, very stretched by the end of March, given the lows of last October. So you had that 5-month period where you started to, bring in a lot of people off the sidelines. And that clearly, sets yourself up to get kind of a corrective period here. I think one other thing from an equity standpoint, Phil's definitely the bond expert on this call here, but from an equity standpoint, the 10-year, even at 4.7 here, that is well within, it's a normal 10-year rate, right? You go back to the 90s and the 10-year was a point higher than that. And multiples on the market were significantly higher. Now, they obviously got ridiculously high in 2000, and that caused for a long, gnashing period up through 02, 03. But when you look at businesses, why are they still doing well? it's a normalized rate environment and they're operating just fine. It's the smaller companies that are more reliant on expensive capital that are probably having some difficulties around there. So again, I think that there are some interesting dynamics. There's always, things to look for, but as sentiment is kind of coming off the boil there and you get a correction going on, you're potentially setting yourself up based on history, based on that fourth year of a presidential cycle, to have a pretty good run in the back half of the year. The one piece that there is no data for, zero data for, and who knows if this were to happen, there is no data to show when if the incumbent got tapped out during the Democratic National Convention this summer, what happens with the return stream there? There's no historical analog for that.
Yeah. Yeah, there are a lot of unknowns right now going on in the political realm, but that's for a completely different show on a completely different channel, so we're not even going to go there. Felipe actually just talked about the last thing that I wanted to talk about, which is what are you doing as far as your role inside of the TAM portfolio? Felipe actually told us exactly where he is. They've backed off a little bit to treasuries from their high yield just in the past week or so. Let's go to the two equity guys because Felipe, see, I do it all the time. Actually talked to it a couple of minutes in there. Basically the risk-free return rate, which is actually why over at AAMA, we did take our balanced portfolio and pretty much put it at a 50-50 mix right now, adding a little bit more bonds in there. But with this risk-free rate being as high as it is, which we haven't seen in a long time, how are Maine and AAMA positioning themselves? Are you looking for changes inside of your equity portfolios right now? Kim, let's start with you.
Sure. So one of the things, we obviously have the buy right strategy that's part of the mix in these three models. That has all covered calls on it. And what we've been doing is we've got expirations on about a quarter of the portfolio that are in June. And given this sell-off here, those things were pretty deep in the money. So we've been rolling those up and out. And basically what that means is we're now getting additional premium income, leaving them in the money so there's still downside protection. And we've pushed that out to December on those. So that will be all potentially additive to the total return for the portfolio. So when you get these movements that happen, it gives you opportunity. And that's part of the reason too around how we run that strategy. We have multiple durations inside of it in an intra-year so that we can get what I call the proverbial, bite at the apple when you get a chance. So we've been moving our feet along that side there. We still feel very comfortable because that's has in the money protection. It still has kind of a synthetic yield that's well over 6%. And we like the positioning. On the sector rotation strategy, what we've been doing on that is we can also do some protective. They're more of like when you reach price targets, you can sell some covered calls against them. So if you get a quick run up, like we saw in semiconductors or you saw in the communications, you're able to kind of go out and even stretch your price target a little bit further, but sell some covered calls that add to the return of the strategy. So that's been a piece there as opposed to making a very tactical move and saying, I want to get out of the position completely. If you still like it, it's close to price target, very easy to do it with the way we have the structure set up. And the last thing that I would mention, the Achilles heel that we've had in one of the positions that we have in the sector rotation is on the financial regional banks. And that was a position we put on at the beginning of the year because we thought price and proof rarely happen at the same time, and it was very, very cheap. The fundamentals have continued to show that's the right thing, but the market has focused more on the fact that there's no rate cuts going on, and there's still a big fear around that. We disagree with that as we continue to check in with the fundamentals, but you always have a problem child under your cover. I'm long 5 kids, so I know about problem children. And that's the same thing inside of a portfolio. But right now, as long as the fundamental data continues to come in, we are maintaining that position. But those are the changes that we've been making under the cover.
Great. Bob, how about you?
Well, within our piece of the portfolios, we've been focusing on high quality balance sheet type companies that have good earnings streams, that won't hopefully give us any negative surprises within the portfolio. And so you might call that a little bit more of a defensive posture. We've liked staples, healthcare, and industrials. We've had basically market or slight under market weights on the other sectors, and we're just focusing on quality right now. And again, we label ourselves as an old school fundamental advisor, and when we have the fundamentals in place that will show us to add more risk within the portfolios and add those more volatile sectors, we will do so. But right now, we just kind of want to be a little bit risk off or a little bit more defensive equity wise.
Aaron, I want to just add a little bit, if I may, even though I was premature in articulating what our positions are.
Absolutely.
It's really interesting to be at this higher yield starting place, because right now our positions are in T-bills, and that's fine. Like if someone was worried about downturn we've seen at the beginning of this quarter, that would be really where you'd want to be. But I think what's important to think about is the opportunity on the other side of that. Now, I really appreciate Kim's playing out how the year normally weighs out. So very strong first quarter, bad April and May. That would be the case. What that would potentially do is keep us in that 5.25% instrument. But at the same time, if stocks downgrade, that you'd likely see high yield bonds move lower, which then moves yields up. So I think a great scenario for us, and I think this would play out for the rest of the team as well, would be to see that historical precedent of bad spring, but then the strong rest of the year. Then you'd see the equity side of the portfolio do well. You take advantage of that, as Kim was saying, from doing some call writing. And from our perspective, we'd potentially come back into high yield bonds, see those both deliver yields that could be north of 7.5%, and then some appreciation on that side as well. So, I mean, I think, with the outlier being if the risk assets really do turn lower for whatever reason, be it geopolitical or whatever, we still could be allocated to investment grade bonds, and that might appreciate. So, bonds are a different story than they were 2 years ago. You need to think about them differently because of our yield high starting place.
Perfect. One of the things that I'm noticing here, and, I can relate this to the TAM story before we get into our closing remarks real quick, is that each of you is actually talking directly to where you fit in the TAM portfolio. With main management being the steering wheel and the lane assist with the SECT and the buy right. Those are exactly in the comments, Kim, that you have actually made. Felipe, with you in that heavy risk off and going to U.S. Treasuries, where everybody feels right now that's a great safe place to be. And you're doing it exactly at the right time. You are putting the brakes on the part of the portfolio that may need it right now, which is exactly what you do. And with AAMA as the gas pedal, we're just looking at the fundamentals, and we're just trying to keep everything going in one direction, which is great, which is why I think this product works so well together, is we all have our own lanes and we all know where to stay and how to do things, which I think is perfect for any advisor or for any client who may be looking at something like this. With that in mind, I'm just going to go back through all three of you. I'm going to thank you real quick for doing this. I know it's tough to get a bunch of CEOs on a phone for a half hour to do something, But if you have any like closing remarks that you want to be sure to add in, Felipe, let's start with you.
No, I'm good. It's just I love this packaged approach, and I think advisors should be heart and light and just hit the easy button and allocate to something that you don't have to manage or choose strategists for.
Perfect. Bob?
Yes, I would agree with Felipe. And, all three of us, firm-wise and individuals, have been through a lot of messes in the markets over the years. And we've seen a lot of good stuff, hot stuff come and go. And I think the beauty of this package is that it's three managers who've been doing this for a long time, who are consistent. They stay to their discipline, and we don't get let off the page to running into Tesla or some of these stocks that look great, and they always come back down to levels that people don't really want to see. So I think it's a good, consistent story for advisors and clients.
Perfect. Well said. Kim, finally you.
Yeah, Aaron, I would just add that I think this is great for the advisors because you have full transparency in all three of our processes. You get a seat at the table for all of our investment committee procedures amongst all three of us. And you have the accessibility where the advisors are able to go directly to us and or go through the sales team. So kudos to everybody.
Perfect. That's great. I think personally, I think we had a good first quarter. I know our TAM portfolios across the platforms that we are on have grown and will continue to grow. I love the fact that we do this. We're going to try to do this once a quarter. So I look forward to talking to all three of you. And one of us who are out there on the sales road will be the one leading this, but we will have our three CEOs on again at the beginning of next quarter. And I appreciate them taking their time. And thank you again all for taking some time out of your day to listen to us. Thanks and have a great day.
Thank
Thanks,
you.
Aaron. Thanks, Felipe.